Is the Bay Area real estate market going to crash in 2026? Let's go ahead and look at the data to identify which direction are we heading. Hey everyone, this is Hanna with the Hanna Group here at Real Estate 38, and this is my beginning of the year prediction video. Where are we going? What's happening in the real estate market? Let's go ahead and unpack that. Now, I have the information I'm going to share with you, but what I want to unpack with you is 2025. What happened in 2025? We predicted that the market is going to be flat to slightly higher. We started the year where the first quarter gave us 10% growth. Then right after that, we entered into tariff wars. Tariff wars slashed that 10%, just gone, wiped out within 2 to 3 months. And then a few months after that, the few additional things that kind of played its part because the stock market went down, H-1B visa attacks towards our engineers here in the Bay Area. So I'm speaking about more Bay Area pricing. So we further gave an additional 7% to end the year with minus 7%. So we started the year with inventory not moving, sellers not willing to change their prices, and we're going to unpack that here with the data. So we started the year with higher inventory, with December pretty much frozen. Not weather, but actually activity, because Christmas and New Year's happened to be in the middle of the week. So just people said, you know what, I don't have FOMO, I don't have a rush into buying a piece of real estate. Let me just get to it in January, and they are. So let's go ahead and unpack that this year. So I collect data from multiple sources, and we collect the data not only what's happening locally, but also in the nation, in the US as well. So the main thing has been affordability. If you're a Republican or Democrat, everybody's talking about affordability. So affordability comes from 3 different places. We have rates, prices, and wages. Rates, the interest rates, everybody's talking about lowering the interest rates, and I'll show you this graph of we're looking better, but we're never going to be 2 and 3%, but at least let's get to the bottom 5s. We're not there yet. Prices have fallen back. Things are becoming more attractive, more affordable. And finally, this year, wages are actually growing more than home prices. So these 3 things always affect affordability. So let's go ahead and unpack that. As you can see in this graph, cooling home prices, we went backward, minus 7%. It's not only California, it's kind of the Sun Belt states. These are the states that gained a lot of equity during the COVID time, where a lot of people said, I can go anywhere, and these states are giving me this tax shelter. I'm going to go there. Well, the seasonality of things, they are more retracting than the northern states that didn't see this growth. So that's what's happening right now. I think this is going to continue in 2026. Now, in this graph of the mortgage rates, what's interesting is that we peaked at 7%. There was just something that everybody saw in the news a couple of weeks back. We hit 5.99%. We went up slightly since then. I think this game of going up and down with the interest rates, I think we're going to hover towards the higher 5s in all of 2026. However, you can actually get relationship discounts if you have money and you're buying $1.5 million to $2 million house. You're putting 20-30% down. You put some money with that bank. For example, Wells Fargo, one of our clients just closed on 4.875. So you could still get that, but unfortunately, you got to pay to play. You're going to have all this money sitting at Wells Fargo Bank for you to get that cheaper rate. So the rates are definitely looking better for 2026. That's where kind of the rate that's going to play its part in the affordability. What's interesting is this inventory graph. So if you see this white solid line, that was 2025. We peaked, that was, in fact, May of 2025 was the peak of the inventory, 1,200 in all of San Jose. We hadn't seen that since 2022 when the Feds increased the rates and we went from 2.5% on the mortgage rates. Fed's rates are short-term, mortgage rates long-term. We went from 2.5 to 6 and 6.25. So that kind of paused the market. We were shocked. However, we are getting back to normal inventory levels prior to COVID. So if you look at the 3-4 lines above the white solid line, those were all prior to COVID. And then post-COVID, 3-4 years, these are the colorful lines that is indicating that, hey, we're actually gaining more momentum with inventory, which usually eases pricing and gives buyers more opportunities. Now, wages growth. In the slides, it's talking about how you could see in 21 how real estate prices jumped up, but the wages did not keep up. However, this year, finally, we're seeing a little bit of relief there to give the homeowners more down payment to put down, better monthly payment. They can actually go up in pricing because their income has gone up. So overall, it's looking good for 2026. And here's the most important part, why we are not crashing. I don't see a crash. Here's why. This is very, very, very important. 40% of the homeowners have no mortgages on their home, meaning they don't have to sell. So they could stay there for another year or two. And in the Bay Area, historically, if you wait long enough, you'll get your pricing. You're right. So even a broken clock, they say twice a day, they are right. It is right. So are these homeowners. If they wait long enough, eventually the prices will go up. So they're not selling if they're not getting their prices. And if you look at 30% have 50% or more equity into their home, and finally the last 30% have 50% or less equity into their home. Even that last bracket of 30% of the folks that have 50% or less, that's still $200,000, $300,000, $400,000, $500,000. And if they don't get their pricing, they have 2.5% interest rate. They've bought 5 years ago. Now it's gone up. Their monthly payment is so low, they're just turning it into a rental and they're not selling the property. So we're seeing that resistance now in the Bay Area, where we saw -7% due to all this drama we dealt with in 25. I think we're getting out of that 26. I think this year it's going to be more fundamental, more foundational. We're not going to grow and we're not going to drop and we're not going to have all these peaks and valleys that we saw in 25. If you look at these forecasts from NAR, Wells Fargo, Realtor.com, and I'm just naming some of the names that you would actually recognize: Fannie Mae, Zillow, Redfin. So all these folks are saying we should be up on average is 1.6%. This is nation numbers. Now, I think here in the Bay Area, we're going to be more flat. We may see some seasonality within the months, where summertime, we will have more inventory. Buyers are going to be out of town, distracted, taking their first vacation. Children are out of school. So that may drop a little bit, but we're going to recover that as the inventory drops a little bit. So I think we're going to be more flat this year. So if you're thinking about buying or selling, reach out to a professional that collects this data to give you more educated information versus taking stuff that is national. Meaning, like, hey, I want to buy in the next 6 months. Should I be in a hurry? No. Take your time. You're going to have more inventory. If you're thinking about selling and you're trying to maximize your equity, do it sooner than later, because you as a seller will see more competition. So feel free to reach out. Let us guide you through this complexities of this market, all the data. When is the best time? How should we present our home? Whether we're trying to achieve highest price possible for the sellers, or let's buy at the cheapest price possible. And what do we do here? Feel free to reach out, 408-515-1613. Until then, bye-bye.